Have you ever found yourself buying something you didn't need just because it was on sale? Or maybe you've been terrified of losing money in the stock market, even when the data clearly showed that investing long-term was your best option. If you've ever wondered why we make decisions that don't seem to make sense, you're not alone. Today, we're diving into the world of behavioral finance, a fascinating field that explores how our emotions and cognitive biases influence the way we handle money. But before we jump in, don't forget to subscribe. I'm aiming for 1,000 subscribers, and your support will help me continue bringing you valuable content. Let's get started. Behavioral finance. Behavioral finance is an area of study that examines the psychological factors and emotional biases that impact financial decision-making. Unlike traditional finance, which assumes that people are rational and make decisions based on logic, behavioral finance acknowledges that human decisions are often influenced by biases, emotions, and social pressures. These biases can lead us to make irrational financial choices that we might regret later. The key idea behind behavioral finance is that our financial decisions are not always based on rational analysis or objective data, but are often shaped by internal and external psychological forces. This can manifest in everything from overspending on non-essential items to making poor investment choices. The role of cognitive biases in financial decision-making. At the heart of behavioral finance are cognitive biases, the mental shortcuts or patterns of thinking that lead us to make decisions that aren't always logical or optimal. Here are some of the most common biases that influence our financial behavior. Anchoring bias. One of the most common biases is anchoring, which occurs when we rely too heavily on the first piece of information we receive. For instance, if you're shopping for a laptop and the first one you see costs $1,500, you might consider it a good deal when you see one on sale for $1,200, even though it's still more than what you originally intended to spend. In this case, the $1,500 price tag becomes the anchor, and you measure the value of everything else based on that initial reference point. Loss aversion. Another powerful bias is loss aversion, which refers to the tendency for people to fear losses more than they value gains. Research has shown that the pain of losing $100 is psychologically more impactful than the joy of gaining $100. This can affect investment decisions. Many people may hold on to losing investments for too long out of fear of realizing the loss, even when selling would be the more rational choice. Herd mentality. Herd mentality describes the tendency to follow the crowd, especially in financial markets. When everyone else is buying a stock or an asset, there's an emotional pressure to join in, even if you don't fully understand the investment. This can lead to bubbles, where prices become inflated and eventually crash when people panic and sell off their holdings. One example is the dot-com bubble of the late 1990s, where irrational exuberance led many to invest in tech companies that ultimately collapsed. Overconfidence bias. Overconfidence bias occurs when individuals believe they are better at making financial decisions than they actually are. For example, a person might be convinced that they can predict the next big stock or the next trend in cryptocurrency, even without a solid understanding of the market. This bias can lead to risky financial decisions, like putting too much of your portfolio into one stock or asset. The emotional drivers of financial decisions. While cognitive biases play a huge role, emotions are often the biggest drivers behind our financial behavior. Emotions like fear, greed, and excitement can cloud our judgment and lead us to make decisions based on feelings rather than logic. Let's take a closer look at the role of emotions in financial decisions. Fear and panic. Fear can be paralyzing, especially when it comes to investments. During periods of market volatility or economic uncertainty, fear can cause investors to pull out of the market prematurely, locking in losses rather than staying the course. For instance, in the 2008 financial crisis, many investors sold off their stocks in a panic, only to see the market rebound in the years that followed. In this case, fear led to poor decision-making and missed opportunities. Greed and FOMO, fear of missing out. On the flip side, greed and FOMO can drive people to take unnecessary risks. When everyone around you is making money in the stock market or cryptocurrency, it's hard not to feel left out. This can lead people to jump into investments they don't fully understand, driven by the desire for quick gains. The cryptocurrency boom of 2021 is a prime example where many individuals rushed to invest without fully understanding the volatility and risks involved. Excitement and instant gratification. The desire for instant gratification can also influence our financial decisions. We might feel the urge to spend on something that gives us immediate satisfaction, like buying the latest gadget or going on an expensive vacation, even if it puts a strain on our finances. This bias is particularly prevalent in consumerism, where limited-time offers or sales trigger an emotional response that makes us feel like we need to act fast, regardless of whether the purchase is truly necessary. How these biases and emotions affect our financial choices. These cognitive biases and emotional drivers can have significant consequences on our financial lives. For example, loss aversion can cause someone to hold on to a stock that is steadily losing value, preventing them from cutting their losses and reallocating their portfolio. Anchoring bias can lead to overvaluing an investment simply because it was the first one we encountered, even though better alternatives may exist. Furthermore, herd mentality can contribute to the formation of asset bubbles, like the housing market bubble of 2008, where people bought homes far beyond their means because they saw others doing the same. The emotional rush of excitement and FOMO can lead to financial decisions that are more about temporary satisfaction than long-term stability. Practical strategies to overcome behavioral biases. Now that we understand how cognitive biases and emotions influence our financial decisions, let's discuss strategies for overcoming these biases and improving our financial decision-making. Recognize your biases. The first step in overcoming any bias is awareness. If you know that you're prone to emotional decisions or cognitive biases, you can actively work to counter them. For example, before making a big purchase or investment, take a step back and ask yourself, am I being influenced by fear, excitement, or something else? Taking time to reflect on your choices helps you make more rational decisions. Automate your finances. One of the best ways to avoid emotional spending or investing decisions is to automate your finances. Set up automatic savings transfers and investments so that your financial future doesn't rely on emotional impulses. By automating your contributions to retirement accounts or savings plans, you ensure that you're consistently building wealth, regardless of market fluctuations or short-term emotional triggers. Stick to a long-term plan. Having a clear, long-term financial plan can help you avoid reacting to short-term market movements or emotional impulses. Whether it's saving for retirement or investing for future goals, a long-term strategy helps you stay focused on what really matters. During times of market volatility, remind yourself of your long-term objectives and resist the temptation to make hasty decisions based on fear or greed. Diversify your portfolio. Diversification is another key strategy in reducing the impact of biases like overconfidence. By spreading your investments across different asset classes, stocks, bonds, real estate, and more, you reduce the risk of making poor decisions based on a single overconfident belief that one particular investment will perform well. Seek professional advice. Lastly, seeking professional financial advice can help you make more informed decisions. A certified financial planner or advisor can provide an objective perspective and guide you through decisions without the emotional influences that might cloud your judgment. A trusted advisor can also help you stick to your long-term financial goals. Behavioral finance is an essential concept for anyone who wants to take control of their financial future. By understanding the cognitive biases and emotional drivers that influence our financial decisions, we can make smarter, more rational choices with our money. Recognizing the role of biases like loss aversion, herd mentality, and overconfidence is the first step in breaking free from their grip. Remember, the key to financial success isn't just about understanding numbers, it's about understanding ourselves. By being mindful of the psychological forces at play, we can create better financial habits, make wiser investments, and ultimately build the wealth and security we deserve. If you found this video helpful, don't forget to subscribe. Let's hit 1,000 subscribers together. Thanks for watching, and I'll see you in the next video.